Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 302nd VideoCast podcast for the week ending July 31st, 2025. We got a lot to cover today, but as always, family first, then we'll get down to business. There's me with Mimi at Junior Olympics this weekend. They rounded out their season. Then we've got Mimi with her two great friends, Layla and Coco. There's Mimi at another game, and I finally broke 80 for the first time. I hit goal one, but as you can see, I got a long way to go with the index to get down to a 9.9. I'm at a 10.4. It's going to take a lot more than one lucky round. That was a grind. I almost blew it on the 18th hole, by the way. I thought I put it in the water. It was 6 yards short. Driver, 6 iron, 56, 2-putt, par 5 over the water. Super excited. 39 on the front, easy peasy. 40 on the back, works for every single shot. But I got it done. So we'll see if I can get the second part of the goal before 4 years of officially playing golf, which come due in December. So I got 4 months to reduce the index by a half a stroke. We'll see. There's Mimi and her team. This is now officially my lucky hat, which is random. It says Southern California Swimming, which will go on great when I go to nice golf courses wearing a swimming hat, but that's the one that got it done. So us hockey players are a superstitious bunch. All right, that's me with Annabelle at one of her games there for Junior Olympics. And by the way, for those of you struggling that have learned golf as an adult like me, I would say the two things that have been really, really helpful in the last few months that have been game changers for me have been this device, the Hack Motion, which deals with flexion and extension in the lead wrist. If you're flexed, you're going to compress the ball. If you're extended, you're going to just really have a tough time. And then this thing, my friend Christian recommended. It's the Pels putter thing, and if you put it offline, it moves these marbles. So that's just, and this one with the small hole, just my 2 cents. I mean, it's a crazy game. I'm sure I'll be rewarded with the 79 by posting a 93 tomorrow, but that's it. It's finally done. The mental block is broken. That's the name of the game. Also, Annabelle's going for athleteoftheyear.org. You can scan the QR code right here, vote for her. They try to make you donate to these charity things. You don't have to do that. It's a free vote as long as you vote through your Facebook account. So that's the QR code. I'll post the link in the VideoCast and podcast posts on the website and maybe on social. But this goes for many weeks. She's winning right now, but it's like a week after week after week thing. Anyway, super proud of her going for that. She's leading right now. On Tuesday, I got a huge media week next week. On Tuesday morning, I'll be doing the Money Show virtual expo, the value proposition in value investing. And you can register for free here. Dan Ives is going to be speaking at a value investing expo. Is kind of interesting, but there are going to be a lot of great speakers in addition to Dan as well. So definitely check that out. Register there. I'll be talking with Mike Larson and excited for that. Also, I've got Yahoo Finance, 2 segments on Monday morning at 9:30 Eastern till. So tune in to Yahoo. I'll be on CNA Asia on Tuesday, possibly BBC on Tuesday, Yahoo. And also, we'll be having a special guest for a 20-minute segment next week. This is not what we normally cover. This is not the things that we invest in for clients, but there are a lot of interested people in Ethereum and how it affects stable coins and how it affects PayPal and how it affects demand for treasury. So we are going to have Andrew Keys, my good friend and client and golfing buddy and all of that on. He's just launched the Ether Machine, a public company with his own, contributed $600 million of his own personal Ethereum, which is a small portion relative to what he has. And he's going to explain what this stuff is, what it means, etc. It's more educational than anything else, but that's going to be an exciting segment, and we're honored to have Andrew on next week, so tune in for sure. A lot of earnings noise this week. Tremendous amount of companies' earnings. Some shot up and then reversed, and then some shot down and then reversed higher, et cetera, et cetera. Short-term voting machine, long-term weighing machine. And what I wanted to do with all the noise is just kind of step back and take a look at the companies that have reported that we've talked about on this podcast and own some for clients and personally. Albemarle crushed it. Stock shot all the way up close to 90 and change, reversed a little bit. But if you zoom out, you can see it's starting its recovery, and we are in the nascent stages. So any weakness can be bought. We'll be going through these this week. I think we're doing Intel and PayPal. We can't do 10 companies in one call. We'll be here until the cows come home. But if there's something urgent to talk about, I would. Boeing, again, shot up. This thing has moved a lot, 135 to 230 in about, 4, 5, 6 weeks. I think it's, we told you a couple weeks back, we took profits on all of our options, which were up huge. And we've shaved a little bit of stock. That's just because there are companies that haven't moved 100% that we wanted to get more of this week. So we did just a tad of harvesting there, but I could see us buying it back if it pulls back below 200, or just riding the rest of it and being perfectly happy because it's still a very sizable position. Baxter appears like it, for lack of a better word, shit the bed. Not the case. That was what we call a kitchen sink quarter to clear the deck for the new CEO of Baxter, who's coming in, and we've covered many times in the podcast. This guy's a winner, 7-bagger in his last company. He's going to turn this thing around. This is going to be easy peasy. The deck is cleared with the spinoff, with the write-downs, with everything else. Revenues are stable. This thing's going to be 3, 4, 5x. It's just going to be a matter of time. And now we got the right guy in doing it. I know everyone's running for cover. I'm telling you, I've never been so busy in the market in one day in probably since early April, when the Liberation Day, when we were just buying everything under the sun in the hole. Well, today was one of those days between buying the shit out of Baxter, buying the shit out of VF Corp, Intel. It was Christmas today, and let's see, Baxter, VF Corp, Intel, no National Oil Well, Varco. I mean, they were just giving stuff away today, and we were like, thank you very much. And what's so amazing is, like, you can look on a daily, you're like, oh, are these going to be okay? And then you look at the numbers, you're like, of course they're going to be okay. And then you zoom out, which is what we do here and what we teach, and you look at the album. We even bought some Albemarle for a few clients that had a higher basis. Trimmed some Boeing. Actually trimmed a small hair of Generac just to raise some cash, because that's also run up huge from the low 100s to almost 200 in a few weeks. So that's probably going to breathe. It's had 2-3 monster days here following earnings. But Baxter, like, this is what it does when it's flushing out, where there's 2009 to 2011, 2001 to 2003, you get this initial down, and then you get this rollover waterfall where everyone says it's over, and then it just works its way back to new highs. Crown Castle, that spiked up on earnings. Now it's resting a little bit. You can see the recovery is just beginning there. Cooper Standard, by the way, I thought today we were only allowed to get bad news until after hours when they took guidance up and the stock shot up to $29. We'll see if we get some follow through. It's broken to new highs there. 2673 was the high after last earnings. And when he came on to our podcast, so now it's at new highs, highest levels since back in 2021. And next stop to take out is $48. So let's see how the earnings call goes and the follow through and everything else going on. Comstock, Again, huge move from $7 to $30. Of course, it's going to retrace back to 17. We almost bought some today, but I think we'd like to see it get lower. If we could get it down to 15 again, we'd load back up the truck for people that don't have enough. Etsy, great earnings, stock shot up. So what happened is Powell, again, had to do Powell be his belligerent, useless Fed chair self, and basically have a very hawkish meeting. So what you saw in the last 2 days is cyclicals, which have been crushing it since the April bottom, got smacked yesterday, because basically the policy that he was signaling implied that he's going to crash the economy, because he's wants to stay restrictive. And that's why you saw tech get bid. They'll do better in a deflationary, higher unemployment environment, which is the policy path that he was signaling yesterday. It won't be executed because Trump is going to announce a shadow Fed and Powell is going to become a lame duck. I wouldn't actually be surprised if they do wind up firing him, because at $600 billion of unnecessary interest costs, it's reckless. It's bad for the taxpayers. It's bad for housing. It's bad for employment. You're seeing weak employment. This guy's got his head up his ass and he needs to go. So that's that. But again, one Fed meeting, it makes zero difference to the recovery of these companies. It makes a big difference for the price movement, the short-term emotional voting machine over a few days after his meeting. But as always, the first move is usually the wrong move. Expect Trump to ratchet up the pressure. And at the end of the day, love him or hate him, Trump always wins. This guy's going to be toast. What he did yesterday was a step above being quote unquote data dependent. What he did was a big FU to the president, and that old dog don't hunt. That's not going to last very long, and you're going to see that ratchet up very, very quickly as more and more public figures come out and belittle him, and they start to put the dissenters on a pedestal, and they start to get the spotlight and completely undermine Powell's belligerence. So next week, I'll tell you how I really feel about the meeting yesterday. But this week, let's stick to the facts, which is Etsy, again, just starting the recovery, shot up after earnings, retraced after Powell. That will all go away. Generac, huge move up here, back to the highs that we saw earlier when we didn't take profits and it went back down to 99. This thing's going a lot higher, but we did trim. We took huge amount of options profits. We had some spreads that were up double and a half. We had some straight options that were up a lot, and a few shares, but this is still a core position for us, and we think it's going to ride a lot higher. You can see this is just starting to recover, but we wanted some cash to buy the things that are down. We bought some Intel, of course, we'll talk about today. Again, it's just in this bottoming process, just like it did in 2009, just like it did in 2002. People are getting up in arms and we are buying the stock. National Oil Well Varco, same story. You start to see the recovery, then you get this bottoming fake out process, and then you go straight up. So this is just a fake out here. We bought a ton more today. PayPal, same story. This recovery is just starting. Another fake out here. We'll go through those earnings. Stanley Black & Decker, again, people bitching about that. This recovery is just starting. Same story. Complete flush out, little uncertainty, and then straight back to new highs. This time will be no different. I think the catalyst for that one is just Powell either needs to be undermined or needs to be removed. One of those two things is imminent. VF Corp, Bracken, unbelievable earnings. The stock shot up to $15. Then you had Powell open his big mouth and all the cyclicals got hit. So this was down, but Bracken did an amazing interview with Jim Cramer, which we're going to listen to in just a little bit. And he laid out the whole case. By the way, the one thing he said at the end is the most important thing he said of the whole thing. He's personally purchased over $3 million of stock, which is kind of a rounding error compared to what we have. But it's nice to see. That's money he pulled out of his own pocket buying in the hole. We love that. This is the same type of bottoming process you saw in 2000, 2001, 2009, 2010. It's a cyclical thing. That's what these businesses do. And back off to the races. So this was a gift, manna from heaven, buying it till our fingers fell off today, and super excited. And we had to raise the cash. We have limits on what we want to do, and things that are doubles in 2-3 months, they're going to take a breather. We use some cash. We'll probably buy some of that back, but to not buy more at these levels for the Stanleys, for the VF Corps, for the Intels, for the Baxters, for the Varcos, these gifts, these are kind of the last stop on the bus before you rocket to the moon, and we didn't want to miss it, so that's what we did. The big story with Cooper, obviously next week we'll be going into this very strongly. They took North American production guidance down. That's just numbers that they get from the industry rags. I think those are going to be too low, but despite taking production numbers way down to 14.9 million from industry, they were able to take adjusted EBITDA up from their initial guidance midpoint of 217.5 all the way up to 235 midpoint. So almost another $20 million of EBITDA more than they expected. And that's why I think you're seeing the stock up over 29. I would love to see it get a 3 handle in front in the next week. That would be amazing. VF Corp jumps after earnings beat as turnaround takes hold. That was the case until Powell came out and shot his mouth off unnecessarily, but it's immaterial. I'm going to be sending him a Christmas card along with Xi Jinping, thanking him for allowing us to get more VF Corp. That one will be a detailed one next week. So Jeff, we're doing CPS, VFC, and probably Etsy next week. Generac we don't have to cover because it went up. Oh no, you need to do Bax. So probably Baxter, VF Corp, CPS. Next, here is the interview of Bracken Darrell, talks quarterly results with Jim Cramer on CNBC. We're going to listen in here.
Has VF Corp finally gotten its groove back? This footwear and apparel company is maybe Vans or the North Face, Timberland, reported a magnificent quarter this morning. The stock at least shot up 3% today, though it was up much more than earlier. You know what the Fed did. Here's a stock that's been a real dog for a long time, frankly. But 2 years ago, the board brought in Bracken Darrell, formerly the CEO of Logitech, to turn things around, and now it looks like he's starting to pull it off. But don't take it from me. Earlier today, we spoke with Bracken Darrell, the president and CEO of VF Corp. Take a look. We are going to go over what I think is one of the most controversial stories that shouldn't be. It shouldn't be because we have Bracken Darrell who's in charge of it, so it was only just a matter of time. Bracken, welcome back to the show.
Thank you so much for having us.
Okay, so the big sticking point here has not been North Face. Has been really good. It's not been Timberland. Wow, I really like it. It's been Vans. And this is the first time since you've gotten there that I detect genuine green shoots in many different ways. So I am going to ask you, can Vans be turned around in the next year?
Vans is going to be turned around, and I'm not giving you an exact time frame, but Vans is absolutely going to be turned around. We've got, as you said, we've got green shoots at the very top. We've got at this year's Paris Fashion Week was just last month. There were probably more skate-like shoes there than have been in a decade, and these trends start at the top. So there's really good luxury trends in our stores. We're overpopulating with premium product. We're doing super well. The Oxford Street store in London, the Fifth Avenue Street store in New York. So I see the green shoots too, and it feels good. And I just, maybe we'll talk about the Warped Tour, but you can feel it there too.
Well, let me just ask you, why has it been so hard? What happened to make what I regard as being a premium, exciting brand into a brand that's really seemed to be, even for you, a not easy turn?
There are 3 things that really happened there. First, the innovation pipeline got very stale. They just didn't launch new products. And then the second thing was they really overextended into value doors with those same shoes that were going very, very broad. They look the same, we're the same. So we just overdid it with a couple of styles. And then the marketing got stale. So those three things, though, we were really reversing engines. So it's taken longer because we've had to really reset the distribution. So we've pulled back on value doors. We've reduced the scope of what we're selling in there. We've reduced our own number of doors by about almost 20%. And you know, the net effect of all that is it's a slower turn. In this industry, it takes time to get new products out. So we've got a great team, though, a super leader, and we're going to be a machine rolling out new products over the next year and year and a half.
Okay, in the interim, it is very telling that North Face remains not only a premium brand, but one that has gotten very exciting again. It never lost it in Europe. I think that people in Europe are just always very exciting about it. But United States, which has been, of course, an obviously important market, seems to have caught fire. So give us a sense of where North Face is now.
You know, North Face is, as you said, it's always been a terrific brand. It really stands for exploration. And, you know, that's appealing to everybody. What we're doing now is we're continuing to innovate in the core business, but we're also bringing out more and more footwear. Our bags and packs business, which is one of the oldest part, both those segments of the business grew over 20% globally. And we're just going to keep pouring it on. And we've got so many opportunities in just bringing out more product for the spring and summer as we go into next spring and summer. So there's a lot of opportunity on North Face globally.
All right, now, Timberland, it seems very exciting at 9% growth. This is a brand that we remember as being fantastic. Then it got small. Can it get big again?
I think so. I mean, I think really Timberland is one of those brands for us that is the brand itself is so much bigger than the business. You know, and the potential, you know, we've really caught fire on the yellow boot, as you said, but we've also got really clear signs that the boat shoe, remember those boat shoes that we used to wear when we were kids? Those are starting to pick up steam again, especially in Europe, but even here in the U.S. And we're really working hard to fuel both those engines and then bring on more and more new products and more apparel. So we've got a lot of opportunities in Timberland, too.
Right now, I had to ask around the office. I always feel old when I do that. But Altra, people are. I thought it was like a cigarette. Altra is a hot shoe.
It's about as far from a cigarette as you can get. It's the best trail running shoe you can buy. It's the biggest, actually, in trail running. We're tied for number one in trail running. We're also moving up fast, the fastest growing of the top 8 shoes or eight brands in road running, believe it or not. And it's gone from about $60 million when we bought it to about $250 this year. It should be $250 or $250 plus this year. So it's really on fire. It's a great shoe, has a unique point of difference, this wide toe box that's really healthier for your foot. So the people who get in it are hooked. And here's the really unbelievable thing. It's a $250 million business at run rate with less than 10% awareness in the U.S. and probably that's aided awareness, meaning, have you ever heard of Ultra? And so people like you, like 90% of people like you, and outside the U.S. it's even smaller. So we can scale this business.
All right, that's important because I'd love to see, without having to spend more money, I don't want you to buy anything till you get your balance sheet where you want it, but that's very exciting. Now there is there's a brand called Carhartt, and we all know it's fantastic. And then you have a brand called Dickies. Now, I told you I bought that jacket at Walmart for $25. It was a Dickies jacket. I would have paid $50. I don't know why Doug McMillon is giving it away at $25, but could Dickies ever beat Carhartt?
First, I love Doug, the CEO of Walmart, and you do too. So whatever he's pricing at, I'm okay with it. Look, I think we don't have to beat Carhartt. We have to be the best Dickies we can possibly be. We haven't in the last few years. Now the trends on there are improving too. So there was a turnaround to do there, and it really dampened this quarter, got into single digits, and I'm really optimistic about that business too. We've got a fantastic team there, led by a super guy, Chris Goebel out of Gap, and he's brought in just a superstar team there. So just like Sunshea at Vans and Caroline Brown and Nina Flood, I've got 4 really great big brand leaders now.
All right, and then last thing, Bracken, I know that you're dealing with the tariffs. You've been able to mitigate some, not all. How life-threatening is a tariff to VF Corp?
Look, the tariffs are the great thing about the tariffs is that they treat everybody equally in our industry. Just everybody's kind of in the same boat. So in an environment like that, we can deal with it. So we're taking cost out, we're relocating factories, and we're raising prices. And we will manage it all. As we go into 27, we'll manage it all so that during 27, we'll offset all the tariffs between those three mechanisms. So it's not life-threatening. We will manage it.
Well, if you had to raise prices, is the consumer strong enough to be able to take price?
I think so. We're going to do it very strategically. And as I said, the good thing is, when you're looking at alternatives, if everybody's raising price, and I suspect they will be in our industry because everybody's going to have the same cost increase, then prices will go up. And then it comes back to let the best brands win. And we believe we have great brands.
Well, I think your situation is, oh God, I want to own the stock myself, not allowed to, but I think it's really time for Bracken Darrell, President and CEO of VF Corp. Brack, I love when you're on the show. Thanks so much. Thank you so much.
Hey, Jim, I just have to say, I now bought on my own. I've taken $3 million of my own money, one by one, and bought stock myself. So I'm obviously more than just a believer. I'm personally invested beyond what you normally get as a CEO.
I like a CEO who's all in with his own money rather than just having the shareholders give it to him. It's because it's much more real that way. Thank you, Bracken. It's great to see you again.
Thank you.
That's Bracken Darrell, President and CEO of VF Corp.
And we're back. Then Baxter, as you can see here, complete kitchen sink quarter, setting the table for the new CEO. We'll cover that one in detail next week. We were buyers today. You'll probably get another couple of days where you can buy the stock. Andrew Hitters coming in, huge home run, 7-bagger plus in his past thing, healthcare business, and this time will be no different. So we're excited about that. Generac shot the lights out. Fantastic job. Resi's crushing it. We'll cover that in detail. Now on to some data. After pandemic lull, Disney's operating profit is growing once again, poised to hit new highs. Most shorted stocks are beating the S&P 500. So short and small was the theme up till yesterday when Powell came out aggressively hawkish as an FU to the president. I can assure you he will not be the one to have the last word, and this trend is going to continue. But the outperformance of small and shorted was 11 percentage points greater than the S&P 500, i.e. Mag 7, over that period. And I think the short-term interruption from yesterday is going to quickly resolve itself back to trend. China's augmented budget deficit widens. They're stimulating. Here's some sell side stuff on Varco maintaining their price target at $20 after earnings. Generac raising their price target to $210. Opinion follows trend. Boeing raised the price target to $250. Varco again, different firm, $19, $20. QXO opinion follows trend. Target up to $33. Intel recovery roadmap taking shape. We'll cover that one. VF Corp upside as return to top line growth comes into focus. Comstock, here's UBS putting a sell on it. Of course, all the European banks are always the most bearish. Varco, they took it to $18. Not concerned. This is a cyclical play. When it goes, it gallops, just like Comstock. Just like Range. I love this. Is gosh, do we have that Mammoth cycle? Let's see. Mammoth stock market cycle. This is where we are on a lot of the names. Is right here. So we've gone through a lot of this on these names, and now you get into a version where you get this final check back before you get to denial and it break out. We're here right now on Cooper Standard. Okay, so we had that shoot up, collapse. Now we're here, and now we're breaking through. This is going to return in confidence. PayPal, we're here. You can see it. Yeah, take a look at this. PayPal. Basically right down here, headed back up to denial, and then straight up. Baba, same thing. This is perfect, actually. If you look at Baba, people are so depressed about this. You can't even see the move in the last few weeks. So you had all this there, then you go up, then you test it. You're right here. You're literally right here in denial. It's breaking out above this right here in denial. And then you're going to get returning confidence is where you get the parabolic move. They're all basically there. PayPal. Baxter's probably down here somewhere. Baxter's right here. Max discouragement. Let's take a look here. Generac. It's going to be a longer call than I thought. Oh, this is perfect. Look at this. Look at this Generac. It's just retesting that. It's right here. It's literally right here. So this is what we're going to get, is that this little pullback. We'll probably reload before our next parabolic move. Then you got VF Corp. Where's VF Corp? VF Corp's probably right down here. Perfect. The spike up and a test down. You're probably right. You might be here. You might be here or you might be here, but either way, I think you're probably here. Inversion. Cooper Standard. It's just breaking out now. This is pretty amazing. Cooper Standard's just breaking out. This is huge. I'm excited. Thank God for today. Thank God I was in front of the screens just ready with my licking my chops and pressing the buy buttons on these that we had one more bite at the apple, like the Baxter's in discouragement, the Intel's in discouragement, the VF Corp's in discouragement or aversion. What else was there today? Diageo, Intel, Varco, Stanley. We bought some Stanley Black & Decker today. Stanley is probably, I think it's right here. Let's take a look at Stanley. Boy, this is not how I expected the podcast to go today, but I'm having fun doing this. All right, so you had this recovery and then a final flush, and now it's starting to recover. Final flush. I think you're probably here. You're probably somewhere between aversion and denial on Stanley Black & Decker. All right, so that's that. Let's get back to some data before we take any more tangents. But sometimes the tangents are where the best stuff is. All right, U.S. firms exceed profit estimates at strongest rate in 4 years. Earnings are going fine. Mainland China's capital inflows into Hong Kong have topped last year's total. That game is on. They'll get a handshake picture with Trump. Stocks will go crazy. The earnings will support it. Off to the races. Growth in credit card spending. We need to relever the private sector, delever the public sector. Each component of speculating trading indicator elevated versus history. Okay, so we're seeing that. This is what we talked about last week. This was a key point I wanted to cover. The reason I said last week, we're growing into a period. We've obviously had a huge move. But I would not expect a big crash of 20%. At the most, you're going to see during this weak seasonal period of August through October is 5 to 10% pullback to be bought. And some volatility at the most. And I wouldn't get too cute with it because there are too many people behind the benchmark that have to buy every single dip that got destroyed in April. And that's why I would stay very constructive. The other reason why is that on average, going back 100 years, the market gets a 20% plus intra-year bear market correction every 4.2 years on average. We have now had 3 of those in the last 5 years, in 2020, in 2022, and in 2025, peak to trough about 20%. So we've pulled forward something like 12 years of these 20% corrections in a matter of 5 years. I think what you're going to see is a lot of recency bias, thinking we're going right back to that, and idiots on TV calling for a big crash in 2026. Yeah, it's an election year. It tends to be choppy, the midterm election years, et cetera. Fine. If we finish the last fourth quarter super strong, of course you're going to get a pullback in probably February, March, and into the election. But I don't think we're going to get another 20% correction. We're kind of overused on that front. I think the 5 or 10s are going to be perfect, and they're going to be bought. Okay, cyclical sector breadth has weakened relative to defensive. Defensives have been given away. Defensives are the Baxters of the world, the Diageos of the world, the Crown Castles of the world, the Hormels of the world. I think those are going to start to get bid. I think people are underestimating those, and that they probably get bid in the fall when you start to see a little chop. AI boom drives largest U.S. grid capacity cost to another record. Again, this is helping the Generacs. This is helping the comm stocks over the long term. Commodity prices rally in July. Lithium, Albemarle. Sharp increases in speculative trading typically signal above average short-term equity returns. So you've got 36 months out. 12 months out, you tend to get another 12%. So that's your sweet spot is 12 months out, which would make sense. And then you get a little weakness into that election. Chart of the week flows into cyclicals versus defensives. Cyclicals have gone straight up until yesterday's Sermon on the Mount. Defensives have been left for dead. I think defensives get bid. Cyclicals may have to take a rest after that for a few weeks, but that creates opportunity. Earnings growth expected to pick up in 2025. Those are starting to be revised upward. If you remember, we're through the downgrading cycle. Technology versus consumer staples. I think you got to have some staples exposure, whether it's Diageo, whether it's Baxter, whether it's Hormel, whether it's, someone mentioned Clorox on the call. These type of stocks. This is tech relative to defensives. I think this is going to shift pretty soon, at least in the short term. Lithium in China surges, so Albemarle is. I mean that thing is going to just be. You're seeing it start to gallop. People can't believe it. It's going to gallop. U.S. firms exceed profit estimates at strongest rate in 4 years. 46% of companies so far have expressed optimism. That's above average. MSCI China Index returned by year since 2010. So year to date is starting to perform. FINRA margin debt over the Wilshire Total Market Index. This is pretty interesting. Margin debt relative to the index is near all-time lows, similar to what you saw after the tech wreck, which implies there's again room for private sector leveraging and public sector deleveraging. And the only way to deleverage the public sector is to run growth hot and run inflation above trend and have growth rise faster than interest costs, as we've done it before in the past. Rally has more room to broaden out. We agree. It's fits and starts. can never take the first 2 days after a Fed meeting serious, and I do think Trump is going to hit him right in the solar plexus and knock the wind out of him. I think yesterday was the straw that broke the camel's back. There was no reason to be that hawkish. Okay, growth sectors are outperforming. Value is outperforming in Europe. That's the last few weeks. A little bit of a divergence. U.S. transmission power outages have become more frequent, and grid reliability is worse today than in the early 2000s. You're seeing it in Generac's results. Average household would need 220% more electricity to go all electric. Online retail spending growth has generally outpaced services and overall retail spending growth throughout 2025 so far. Relative strength versus the S&P 500 in the last year. Staples have been extremely weak relative to the S&P 500. Staples in healthcare, that's where you're going to see some opportunity. Staples, healthcare, and real estate, I think that's where you're going to see some outperformance in the next 18 months. Materials, same thing. Utilities, I wouldn't get too interested in that. Financials, selective. I like and discretionary, same thing. So industrials have had a run. Technologies had a run. So, you've seen it in Generac, you've seen it in Boeing. So, probably short term, they're going to have to consolidate those gains. There's just no two ways around it, which is why we did a little trimming, but nothing serious. Energy is where you're going to find opportunity. So this is kind of where all the gains have come from. Unfortunately, we've had enough exposure and just crushed it the way we were positioned. But now these that were positioned for where the puck is going are going to start to go as well, which we're excited for. Year-to-date sector performance, so healthcare, discretionary, energy, staples, worst performers, industrials, tech, utilities, comm services, best. Average S&P company one-day reaction to earning misses. So this has been the worst one-day earnings reaction to earnings misses. The average company down 5.2%. The last time you saw that were the lows in Q3 2022. So just keep that in mind, that these companies that are getting hit the hardest, they're probably bottoming here, because back here, this was when tech was getting hit the hardest. Down here is when cyclicals are getting hit the hardest. They're going to be the ones that lead the next leg. Bull market's built on quiet strength, quarterly estimates going up. U.S. and EU's power demand expected to accelerate sharply. That's great for Comstock, Range Resources, etc. Let's make a deal. M&A starting to come back. Wall Street forecasts revert back from the tariff turmoil. Opinion follows trend. They're all taking their S&P targets back up. Small caps, unmissable deep discount. Premium and large cap book multiples is the widest in 25 years, going all the way back to the early 2000s. Miss that at your peril. Small and shorted is the theme for the next handful of months through year end. United States GDP growth rate was strong. Stable coins are the 18th largest external holder of treasuries. Expect that to be even higher now that the Genius Act is through, which is part of the reason we're having Andrew on, is he's going to explain to us how that works, because I think half the stable coins are on the Ethereum blockchain. I don't know anything about this stuff. Like I read it, I don't understand it, but it's important that we know it, because we're invested in things that are affected by it. And it'll be good information for everyone to have from seriously the best person in the business to learn about it, because he helped develop it. So services spending downshifts running well below trend in 2025. Potential wall of worry for 2025. Performance in August, the second term of post-election years. Okay, so August tends to be a little weaker. Maybe this is a little precursor. Talking about housing affordability, net share of survey who say jobs are plentiful. So you're seeing more weakening jobs data. 6 charts on S&P 500 activities firming up. Revenue per employee, sales and EPS beats are strong. Leverage ratio lowest since 2015. Again, opportunity to re-leverage as rates come down. Corporate activity, M&A plus IPO starting to tick back up. CapEx to sales is strong. and improving for ex-tech sectors as well. Russell 3000 short interest is near records. That's not the time to be a seller. It's the time to be a buyer. They're the first buyers as they get smashed, like the shorts in the hole in early August are still that short in small caps, which will be the first buyers. Next is rise of stable coins, which we've covered. Too complacent. Russell 2000 bottom up consensus estimates. Okay, hardly moved. Two Fed, that's what the way it always looks. It's always darkest before dawn. Two Fed governors dissent at July FOMC meeting. It's the largest number of government dissents since 1993. So the natives are getting restless, and now internally he's getting dissent. In addition to President Trump's dissent and common sense argument that we're paying $600 billion more with taxpayers' money on interest than we need to be, particularly when inflation is quelled. And by the way, your target shouldn't be 2% right now. If you get to 2%, we are going to have a catastrophe, a deflationary crash with the amount of debt that we have in the system, particularly in the public sector, not in the private sector. Your goal should be 3% inflation. Your goal should be to actually increase inflation to 3% and lower rates to the neutral rate, which would be 3% if you're targeting 3% inflation, and get growth humming like we did coming out of World War II when debt to GDP was 120%, and we brought it down to 63% within a decade, less than a decade. Hires, total private, again, this is collapsing. Powell needs to pay attention. Net call volume for the most shorted stocks versus the rest. So shorts, everything's setting up for short squeezes, and those are concentrated in small caps, which is why we've been pounding the table, continue to be accumulating small caps on pullbacks. FX is a tailwind for Q2. That'll continue in the back half. Dividend yield still inexpensive versus history. Neglected. A lot of our names fall into that category. That's where the opportunity is. Value, same story. FINRA margin balance barely coming off the mat. So there's a huge opportunity to re-lever up. CapEx increasing across the board. Case-Shiller home price national index coming down, negative for the first time in a few years. And then going back to that since the great financial crisis. Ben Graham, the intelligent investor, is a realist who sells to the optimists and buys from the pessimists. There were a lot of beautiful pessimists in the market today, and we took full advantage of it. And there were some optimists in a couple names where we helped them out with a few of our shares. Alibaba to launch AI-powered glasses, creating a Chinese rival to Meta. I use the Meta glasses. They're phenomenal. Don't tell anyone, but I listen to earnings calls while I'm playing golf and no one knows. And it's great because I can hear everything. I can be engaged, but I can still get work done at the same time. Chinese investment into Hong Kong surges to record high. Next, China leaders vow support for economy, crackdown on disorderly competition. This is all good stuff. It's all in the pipe. We're going to see it in earnings this quarter. We're going to see a deal this quarter. Baba's going to go into that parabolic move. Everyone's going to be surprised, except for those amazing, incredible, loyal listeners of Hedge Fund Tips with Tom Hayes that are making all that money and smiling so wide they could eat a banana sideways. That's what's going to take place. So Hong Kong growth fastest since 2023 as spending stabilizes. China's lithium markets gripped by possible supply disruptions. We love it. Albemarle goes up. Goldman's asset arm says emerging markets catching only first wave of flows. First wave of flows. Remember 2001 to 2007, we've used that analog multiple times. Generac beats quarterly estimates on robust sales of power backup equipment. Early days, ladies and gentlemen. Boeing reports strongest revenue in 6 years. A year ago, you couldn't give away the stock. 3 months ago, people were selling it like it was on fire. We were in the market as busily at 135 as we were today with VF Corp in the 11s, with Baxter in the low 20s, with Stanley Black & Decker, with Varco in the 12s. I mean, it was Christmas today. It was absolute Christmas, selling the things that have had quick doubles and using it to buy the things that are going to be 4, 5, and 6 baggers. That's what we do. Boeing slashes losses as CEO touts our turnaround year. So now everyone's excited about Boeing. It's going to take a breather. Intel beats on revenue, slashes foundry investments as CEO says no more blank checks. That's a good thing, not a bad thing. Albemarle posts surprise second quarter profit on lithium demand sales surge. Etsy posts second quarter revenue beat amid higher spending on AI marketing. Disney stock is ready to rally after a lost decade. No one wanted it at 85. Everyone wants it at 120. Disney's Fabulous 4 rocket, which means it probably takes a rest. Disney's Fabulous 4 rockets to 100 million, 18 million debut. What's this one? This is Etsy. We'll cover that in detail next week, I think, or the week after. Fed risks a deflationary spiral by not cutting rates, these bond experts said. This is a key headline, ladies and gentlemen, what I've been saying. Fed risks a deflationary spiral by not cutting rates, these bond experts said. So-called Kindleberger spiral could materialize if capital flows dry up. Why is this not letting me in? Anyway. Fed hasn't seen a split like this in 30 years. That people dissenting, Chris Waller and Michelle Bowman, both dissenting against Powell. Jefferies sees value, small caps joining record U.S. stocks rally. We agree. Value and small caps, how you doing? That's been the case the last 8 weeks plus until yesterday, but that will resume. Stock picking hedge funds make comeback in market turbulence. Yes, sir. U.S. LNG producers climb as EU agrees to $750 billion in energy purchases. Everyone thought they were going to gang up against the U.S. and fall into China's arms. The exact opposite happened. Duh. Ignore the noise and follow the leader. Stock market and sentiment results. Intel update. So you can see here the stock is down because the fundamentals are down. In the short term, the market's a voting machine. In the long term, it's a weighing machine. It is weighing garbage fundamentals, okay? Both on the weighing machine and the voting machine. But Lip-Bu-Tan is here to save the day. And we're going to discuss how. With Q2 earnings season now in full swing, Intel was the first of our names to report earlier last week. Headline numbers were strong across the board. Revenue came in at $12.9 billion, flat year on year, beating consensus by nearly $1 billion. Let me repeat that. Revenues beat consensus by $1 billion, which means the downward spiral has stopped and now it's stabilizing and then it can start to recover and landing $500 million above the high end of management's prior guidance. So not only did they beat by $1 billion, they were up $500 million above the high end of management's prior guidance. In fact, Q2 was the third straight quarter of revenue coming ahead of expectations. You could not tell that by the stock price and the short-term emotional voting machine. Earnings were weighed down by restructuring costs and one-time equipment impairment charges. Excluding those, Intel delivered EPS of 10 cents a share ahead of both prior guidance and consensus estimates of 1 cent a share. Not only that, but Q3 guidance held up well with revenue expected between 12.6 and 13.6 billion compared to the street's 12.66 billion. Keep in mind, Q3 has historically posted high single-digit sequential growth. Current guidance implies -2% to +6% due to potential tariff pull forward. That sets a low bar for a beat if demand holds up. But despite the beat and solid guidance, shares fell by nearly 10% after the report. In our view, a gift from the gods. What spooked the market and continues to weigh on the stock comes down to the foundry business and the about-face and strategies that Lip-Bu-Tan is bringing to the table, and rightfully so. Here is what was added to the 10Q and what Lip-Bu-Tan means by making it his top priority to, quote, become a more financially disciplined foundry. He did not say, get out of the foundry business. He said, become a more financially disciplined foundry and, quote, if we were able to secure a significant external foundry customer for Intel 14A, our next generation semiconductor manufacturing process technology, we may pause if we are, okay, here, I love this. Here we go. If we are unable to secure a significant external foundry customer for Intel 14A, our next generation semiconductor manufacturing process technology, we may pause or discontinue our pursuit of next generation leading edge process technologies, which may have significant strategic business, financial, and operational and reputational risks and repercussions. This is a complete U-turn from Pat Gelsinger's build it and they will come mentality. In Lip-Bhutan's own words, quote, over the past several years, the company invested too much too soon without adequate demand. Going forward, our investment in Intel 14A will be based on confirmed consumer commitments. There are no more blank checks. Every investment must make economic sense. He's now stewarding our capital the way we would steward our capital because he's got skin in the game. He wrote, Bracken wrote a $3 million check for stock. Lip-Bhutan wrote a $25 million personal check for stock, okay? And the shift in strategy is being viewed as putting the foundry's future in jeopardy, meaning without landing an external customer, no 14A, and no future Intel internal production. We have a much different take. The foundry business has been a cash incinerator for years, losing $3 billion this quarter alone with an operating margin of negative 71.7%. There's no planet where that is sustainable, and Lip-Bhutan has made it clear he is not willing to eat those losses forever. Until Intel sees external customers stepping up with volume commitments, they are scaling back the massive CapEx build-out. In other words, they are no longer the bag holders. And believe it or not, they actually have the leverage here. Intel is one of only 3 leading-edge chip fabs left in the world. No company that is currently relying on the kindness of strangers for advanced foundry, whether it's NVIDIA, Amazon, or anyone else, wants to have all their eggs in the TSMC basket. This is essentially a warning shot to engage and get serious, or Intel will walk away from the foundry business. No company in their right mind wants that. At the same time, it doesn't hurt to have the US government as your co-investor and subsidizer in chief. The government is committed to reducing dependence on Taiwan's semiconductor monopoly and creating a duopoly with Intel. I wouldn't bet against the richest treasury in the world to make that happen. Many bet against the government's commitment to EVs through Tesla subsidies. Ask them how that turned out. The fact of the matter is that the US cannot afford to let Intel struggle. And just last week, we got further confirmation with the AI action plan showing exactly how serious they are. Restore American semiconductor manufacturing. America must bring semiconductor manufacturing back to the US soil. Streamline regulations that slow semiconductor manufacturing efforts, support next-gen manufacturing, prioritize investment in these emerging technologies, and usher a new industrial renaissance, chips and R&D programs, etc. But again, while all the focus is on foundry and reinventing the future, our original thesis has always been that AI and foundry are just whipped cream on top. We continue to believe the legacy PC and server business, which makes up 60% of the sales, is worth $45 to $50 per share on its own. That gives us all the margin of safety we need and makes the short-term noise and uncertainty exactly that, just noise. People seem to forget that despite all of Intel's issues, they are still like what we like to call the leader of mediocre chips. They continue to dominate market share in both PCs and servers with 70 to 80% share in the client market and 55% share in servers. This remains the core of our thesis, and Lip-Bhutan has made it clear that this is where the focus needs to be. They're fully committed to doubling down, engaging with customers early in the product cycle, and winning back share. That is music to our ears. And let's not forget, we have a miracle worker at the helm in Lip-Bhutan. The chart of Cadence Design Systems before and after he took over says everything you need to know. He stepped in after an 86% collapse in this Cadence stock. Over the next 14 years, Cadence became a 68 bagger, 68 bags. 1 million became 68 million by the time he left. Intel is his next turnaround project, and in his own words, he wants to, quote, pull off a comeback that will be studied in business schools for generations. So this is not only about money, this is about his final run legacy. If there is one person who can pull it off, it's Lip-Bu Tan. Lip-Bu Tan would have never taken the job if he didn't truly believe Intel could be turned around. He spent 2 years on the board before resigning, clearly in disagreement with Pat Gelsinger's bending spree and direction. The point is, he knows the business inside and out, and the industry, by the way, and there are no surprises for him. He isn't chasing money. The only thing he's chasing is admission into the Semiconductor CEO Hall of Fame. And if his track record wasn't enough, within 30 days of taking the job, he wrote a $25 million check out of his own pocket at a $24 cost basis. That puts you in at lower prices than Lip-Bu Tan, one of the best operators in the industry. Betting against Lip-Bu Tan has never been a profitable trade, and we don't think this time will be any different. Here's everything you need to know following Q2 earnings. You can go through that step by step. We highlighted all the important parts and the deck and the 10 key points. Revenue of $12.9 billion beat consensus by roughly $1 billion and came in nearly $500 million. Above the high end of prior guidance. Intel products revenue reached $11.8 billion, up slightly sequentially and ahead of expectations across both client and server segments. On the client side, demand continues to benefit from the COVID-era PC refresh cycle, with AI PCs representing a growing share of the mix. And in the server business, Granite Rapids is ramping as planned, with hyperscalers continue to refresh their CPU installed base. 2, gross margins are expected to face near-term pressure due to the significant ramp-up of Lunar Lake Q3 and Panther Lake later this year, as cost per wafer remains high in the early stages. However, as volumes increase, management expects gross margins to expand into 2026, continue improving for several years. Management anticipates 40 to 60% fall through for gross margins next year, leaning towards high end if volumes scale as expected. 3, management remains on track to achieve 2025 operating expense target of $17 billion, with plans to reduce OpEx further to $16 billion next year. 4, 18A reached a key milestone at the start of production wafers in Arizona and remains on track for introduction by the end of 2025. It will serve as the foundation for at least the next 3 generations of Intel client and server products. Most importantly, management continues to expect reasonable returns on investment from Intel products alone. However, as 18A ramps up to high volume, management expects to be in a stronger position to attract external customers as performance yields improve, driving very strong returns over the long term. 5, the first Panther Lake processor SKU remains on track to begin shipping later this year, with additional SKUs coming in the first half of 2026. 6, Intel Foundry revenue rose 3% year over year to $4.4 billion, but continues to bleed significant cash, posting an operating loss of $3.2 billion, up from a $2.8 billion loss a year ago. Lip-Bu Tan's top priority is becoming a more financially disciplined foundry, scaling back CapEx until there are firm customer volume commitments for 14A. As part of this shift, Intel canceled manufacturing products in Germany and Poland and slowed construction in Ohio to better align with market demand. 7, management announced additional layoffs building on the 15% reduction announced last quarter, with the target of cutting headcount to 75,000 employees by year end. That compares to a peak of 132,000 under Gelsinger, with most of the reduction already complete. As a result, the company has eliminated 50% of management layers and remains on track to implement its return to office mandate beginning in September. Can you believe it's 2025 and they're just now doing a return to office mandate? Like, you can't make this stuff up. Capital expenditures for the full year are expected to total $18 billion, $5 billion below the original guidance set at the start of the year. Management noted that maintenance CapEx accounts for about half of the current level, or roughly $9 billion, and expects both gross and net CapEx to decline further in 2026. Deleveraging the balance sheet is a top priority in 2025. Management raised $922 million through the Mobileye offering in July and is on track to complete the $4.46 billion sale of Altera stake in Q3. Additional opportunities to monetize non-core assets is also under review. And 10, Q3 guidance includes a revenue range of $12.6 to $13.6 billion, down 0.2% year on year, gross margins of 36%, up 18 basis points, and EPS of flat, up 46 cents year on year. Revenue guidance assumes prior quarters benefited from tariff pull forward, with management conservatively projecting growth of -2% to +6%. Traditionally, Q3 sees high single-digit sequential growth, setting a low bar if demand holds up. So here are the key things from the earnings call. We've highlighted in green what you need to know. And now on to PayPal. Again, just pulling up the mammoth cycle here. This is despondency. Looks like we're now in aversion. So this would be rather discouragement. Anxiety we got up to at $90. $93. Then back to 55, we were in aversion. Now we're getting back up to denial before we bust out to the parabolic move. Going back to the mammoth cycle. If you're not watching this on YouTube, I would highly encourage that. You will get 4 times as much value, but if you can only do it listening, it's better than nothing. So here you can see cash flow near record all-time high, price near record all-time low, certainly in the last 10 years. Revenues continue to reach records. Return on invested capital is accelerating up to low double digits from high single digits. Gross margins are starting to re-accelerate. PE is near record low. Price to free cash flow near record low. Balance sheet is better than ever. Free cash flow per share is double what it was a few years ago. Common shares outstanding has come down about, looks like about 15% over the last 3-4 years. Revenues up a third since 2021. PayPal delivered another lights out quarter this week. Revenue of $8.3 billion, up 5.1% year on year. Beat consensus by $220 million, while non-GAAP EPS of $1.40 came in 10 cents ahead of expectations. Management also raised full year EPS guidance to $5.15 to $5.30 from $4.95 to $5.10, and lifted full year transaction margin dollars, essentially gross profit, to 15.35 to $15.5 billion from prior guidance of 15.2 to 15.4. Going through the earnings call, it is hard to find anything not to like. The highlight color is overwhelmingly green. The one soft spot was adjusted free cash flow, which came in at just $656 million, down 42% year on year, and well below the $1.62 billion the street expected. In typical shoot first, ask questions later fashion, that was not enough for Mr. Market. That was enough for Mr. Market to send the stock down by nearly 10%. That sell-off looks even sillier when you realize the slowdown was entirely due to timing shifts in working capital, not any slowdown in the business or permanent impairment. These effects are expected to reverse in the second half. If you are an investor and not a trader, the only number that should matter is management reaffirmed full year free cash flow guidance of $6 to $7 billion. This machine spits out of cash in the year, which is just mind-boggling, which implies a nearly 10% free cash flow yield at the midpoint. To be sure, sell the stock because free cash flow is lumpy, which has long been the norm for PayPal. To those who saw these results, listened to the call, and still decided to sell, we will gladly be mailing you Christmas cards for the next few years. We already knew Alex Chriss was a winner based on what he accomplishment leading the small business group at Intuit, but each quarter continues to raise our confidence even higher. Remember, short-term voting machine, long-term weighing machine. I've built my career on finding opportunities where price disconnects from improving fundamentals, and when investors are bending over backwards to find reasons to sell. Just know that despondency tends to revert to euphoria. That flip might be closer than anyone realizes. We'll be happy to return the early Christmas favor and hand out some shares when the stock is trading well over $150. Here's everything you need to know following the results. You can go through this. Profitable growth is greater than empty calories. You can see this lumpy cash flow, 6 to 7 billion years. All these decks. We highlighted the important things. Go through it. Here are the 10 key points. Number 1, PayPal posted its 6th consecutive quarter of profitable growth, with transaction margin dollars reaching $3.84 billion, up 7% year on year, 8% excluding interest on customer balances. Transaction margin rose to 46.4%, up 62 basis points year on year. Declining transaction margin dollar growth had always been central to the bear case, with drops of 3% in 2022 and negative 5% in 2023. Alex Chriss has flipped that on its head, delivering 5% growth in 2024 and guiding for another 5 to 6% growth in 2025 and targeting high single-digit growth by 2027 with a long-term ambition of 10%. 2, Venmo posted revenue growth over 20%, its highest since 2023. Total payment volume grew 12% during the quarter. accelerating quarter over quarter to the fastest rate in 3 years. Pay with Venmo total payment volume grew more than 45%, while monthly active accounts for the Venmo's debit card rose over 40%. These debit card users have some of the most attractive economics in the ecosystem, with both Venmo and PayPal debit card users showing 6x the transaction activity and 3x the average revenue per account. We have always said Venmo is a verb, and when Alex Chriss took over, there were real doubts about whether Venmo could return to growth. Fast forward today, it's on track for well over $2 billion in revenue by 2027 and just getting started. 3, one of the most important pivots in strategy under Alex Chriss has been choosing profitable growth over what he called empty calorie revenues, aka firing unprofitable PSP Braintree customers. As expected, Braintree total payment volume growth has slowed dramatically, posting just 2% for the past 2 quarters, down from 18% a year ago, with PSP consistently making up over 40% of total payment volume. This shift created short-term revenue headwind of roughly 5% in recent quarters. The good news is that not only have transaction margin dollars improved meaningfully, but the business has also reached an inflection point. Management expects Braintree total payment volume to reaccelerate in the second half of the year and beyond, following peak pressure from contract renegotiations and the removal of low margin volumes. Just take a look at this inflection. 4, online branded checkout grew 5% year on year, a slight deceleration from 6% growth in the prior quarter, and one of the few soft spots in the report. The slowdown was driven by weakness in tariff-impacted regions such as Asia-based marketplaces. Without that pressure, growth would have held steady at 6%. The good news is that softness has already stabilized in Q3. Management continues to guide for full year growth in the mid-single digits, with improvement expected over the coming quarters and a path to 8 to 10% growth by 2027. This is largely driven by continued adoption of the new checkout experience, which made up 30% of US branded as of February 2025 and has already reached over 60%, on track to exceed 80% of global transactions by 2027. 5, buy now, pay later continues to accelerate, and with volume growth of more than 20% and monthly active accounts up 18%, outpacing the overall market as PayPal gains share in the space. These customers bring highly attractive economics, with average order value more than 80% higher than a standard checkout transaction. Management also noted ongoing improvements in charge-off and stable low delinquency rates, with plans to expand into additional markets and increase marketing efforts throughout the year. 6, total active accounts grew by nearly 2 million from Q1, up 2% for the quarter, reaching an all-time high of 438 million. Monthly active accounts also rose 2% year on year to 226 million, as the largest two-sided platform in the world continues to get bigger. 7, adjusted free cash flow came in at 656 million, well below street consensus of 1.62 billion. While a soft number caught the market off guard, management said this was simply due to timing shifts in working capital that are expected to reverse in the second half. More importantly, they reiterated full-year free cash flow guidance of 6 to 7 billion with a B, implying a nearly 10% free cash flow yield at the midpoint. 8, share repurchases totaled $1.5 billion for the quarter, bringing the trailing 12-month total to $6 billion and reducing the share count by 7%. Your slice of the pie got 7% bigger without putting $1 new of cash into the company. Management still expects to buy back $6 billion of stock this year, implying a buyback yield well over 8% at current prices, with $13.7 billion in cash and investments versus $11.5 billion in debt. We think there is plenty of dry powder for management to ramp up repurchases if Mr. Market continues on one of his manic bouts. 9, management noted that recent talk of certain banks charging for access to customer data, which triggered a sharp sell-off in the stock, is immaterial to PayPal. They confirmed the company will not be impacted by any such pricing changes. 10, management raised full-year guidance, now expecting non-GAAP EPS of $5.15 to $5.30, 11 to 14% earnings growth compared to prior guidance of $4.95 to $5.10, 6 to 10% growth. Transaction margin dollars were also raised to a range of $15.35 billion to $15.5, 5 to 6% growth versus previous guidance of 4 to 5% growth. They reaffirmed free cash flow estimates of 6 to 7 billion, share repurchases of 6 billion, and CapEx of around $1 billion. This guidance still looks relatively conservative, with the low end assuming up to a couple of points of decelerating in e-commerce spending, though management has seen no evidence thus far. Here are the key points from the earnings call highlighted in green. And you can go through those. And quick Boeing update. We've had a lot of companies report fantastic earnings this week, and we'll be covering all the names in detail in coming weeks. But just to hit on a few quick points of Boeing, if you wanted to see a textbook example of despondency reverting to euphoria, look no further than Boeing. Just a few months, you couldn't give away the stock in the early 130s. We were on an island saying that we were bullish and got looked at like we had three heads. Now it's at 225, and it's all anyone wants to talk about. As for Q2, it all comes to two words. Kelly Ortberg, in his own words, 2025 is Boeing's turnaround year. We could not agree more. As we always say, the number one thing you want to see in a turnaround is free cash flow, especially for a company like Boeing, and they absolutely delivered. Adjusted free cash flow for the quarter was a usage of $200 million compared to consensus estimates of a $1.8 billion usage and a year ago figure of negative $4.3 billion. Management now sees a usage of just $3 billion as a reasonable full-year target compared to prior guidance of $4 to $5 billion cash burn. Most importantly, the long-term $10 billion of free cash flow target remains intact. That free cash flow is being powered by a business firing on all cylinders. Boeing recorded the highest number of deliveries in both Q2 and the first half of the year since 2018, along with its strongest quarterly revenue in 6 years. Meanwhile, the 737 program is now running at a production rate of 38 per month and is expected to climb to 42 in the months ahead. Ladies and gentlemen, this thing is going higher. It probably consolidates in the short term. Many thanks to Kelly Ortberg for his miracle work in progress and amazing run we've had in the last couple of months. More to come next week. General market, a little bit elevated. Active investment managers taking some risk off. Again, I think it's more of a sideways chop than it's going to be any material corrections beyond a healthy 5 to 10% pullback. NASDAQ top 30 weights earnings estimates went up for this year by almost 1% and next year by 1.14%. Dow, same thing. Earnings are going up 1.25% this year. 56 basis points next year. That's top 30. Well, that is the 30. Continuing jobless claims. Nothing really big here. Let me just see. GDP came in stronger than expected. That's that. FactSet earnings. Growth rate is 6.4, was 4.8, probably coming around 7 or 8 when all is said and done. And we are on to the Ask Me Anything questions. So for those of you who don't like the Ask Me Anything, thank you for tuning in. We'll be back next week, same time, same place. Those of you who love the AMA, we're just getting started. So here we go. And here's our first question from York Bourgeois. Hope your earnings season has been going great. With Comstock now below 20, could you describe the comparison between them and National Oil Well Varco and where you put new money? Look, we own Comstock from $8, so we're not really chasing up here, although I am tempted to buy some stock at these levels. But Varco is a much better bargain because it's just getting started. So they're two different businesses. I could buy. I mean, if Comstock goes back to 15, I'd put new money to work there. But I mean, with an $8 basis, I'm not going to bring my basis up just because of a simple pullback. I like Varco here for a new stock for the long term. Brennan Burkhart. I'm 14 years old and have been trading. My dad introduced me to your podcast. He's a big fan of your work and encouraged me to start listening. Hey, welcome, man. Congratulations. 14. You're a little late. I started when I was 10, but, I think you'll catch up. No worries. While doing some research, came across the stock Grab. My dad suggested I like balance sheet cash flow revenue. From what I saw, the company seems to have low debt, strong cash flow, solid financials. What am I missing? You're missing. We covered this one a couple weeks ago. I hate the food delivery business. I think it's garbage business, but we've covered this one a few times in the last few weeks. I think it probably works as a trade. I think your instinct is correct on this one, Brennan, but it's not the type of business that I would want to own for anything more than a trade. It is recovering. It is growing, but let's just take a quick look here. So, it's trading at 7 times sales, 200 times earnings. And I think the growth rate has leveled off and there's a lot of competition in that. So for me, it's not what I'm interested in, but I think you're probably right from a trading standpoint, but from an own forever, there's no real moat. Eaton, Daniel, trying to work on my mental valuation muscle and just wanted your thoughts. VF Corp said they have saved 300 million in their cost structure, expect another 500 to 600 million in savings to flow to net operating income. So just on the savings growth, assuming no growth, they could be trading 10 to 15 times 800 million. This sounds like 8 billion to 12 billion valuation from today's 4.5. So double to triple with no growth and possibly another triple on top over the next 5 years, assuming fixed costs stay flat and growth comes back at single digits. I think you're in the ballpark. I think Bracken is going to take this thing from our original model. We had underwritten it for $50, and then we re-rated to $100 after he made some adjustments on probably about a year in, and we have no change to outlook. Everything he said he's going to do is hitting on all cylinders. He got a little sidetracked with the tariff thing, but it's completely immaterial because everyone has that, as you saw in his interview. So you're roughly in the ballpark. How you got there is a little different, but the key thing that you need to know is it's going up, and it's going up a lot. Johnny, thoughts on ABEV in Brazil, 6% dividend yield. I don't really like this business, but this is more of a value trap. If you want to buy it for the yield, have at it. It's just if you're going to go into alcohol, you want to be on the premiumization side. People are drinking less and higher quality. I mean, there's nothing not to love here in terms of the free cash flow growth. I think their balance sheet, though, might have a little bit of leverage, more leverage than we're comfortable with. $4 billion of cash. No. I mean, I don't see anything egregiously wrong with this business at all. I just don't think you're going to get the move you expect to get, but I don't think you're going to get hurt either. So I just think there are higher and better uses. And let me just see what is happening with the revenue trends. Yeah, it's been headed down, but I don't think you get hurt with it, but I don't think you make a lot of money either. Okay, STINGNJN, Stigen, Atchin. Thoughts on Worldline, WLNPA. No real signs of recovery in revenue or free cash flow or return on invested capital. I wouldn't just buy PayPal. You got a winner running it. Why are you going to screw around digging in the dumpster? You dig in the dumpster, you get fleas. Can you look at Align? They got destroyed recently. You know, people have been bringing up this stock every week, and I continue to say no. I don't think there's any change in that. I'm a pass. I think there's too much competition. I don't think they have a moat. Jay Hammond. Holcim owns Elevate Roofing Products. Is Holcim a buy? Not for me. Revenue's going down and stock price is an all-time high. Hard pass. Just by QXO. Bet with Brad. Henry Hasselfeld. Love the show. Share it with everyone I know. Thank you so much. I appreciate that. Best compliment you guys can do, best way you can pay back, share it with 2 or 3 people you know who love markets and could really benefit from having a positive framework, a stable framework, not chasing shiny objects and eventually getting taken out to the woodshed. All right, so here's a guy nervous that about Mag 7, they're pushing higher, feels like they're never going to end, blah, blah, blah. Do not chase them. That's all I can tell you. They will be the first ones to get hit this fall when you have choppy volatility. Johnny S., what do you think of the financials for SPT? What is this thing? Sprout Social? Influencer strategy. I mean, social media management. I have no edge on what their competitive mode is, so hard pass. I stay away from companies like that. Could work. It's just not, it's outside my framework. Isaiah G. Following working in a completely different industry, following enriching, recommend to my peers whenever I can. By the way, go to hedgefundtips.com, click on terms. This is all opinion, not advice, for educational purposes only. Monster Beverage as a short. This is one of the best performing stocks of all time, and he wants to short it. Cash flow is at a record high. Price is not. Revenues keep growing. There's nothing to short here. So, I mean, could it go down in the short term as a short-term trade? Yeah, but that is a sucker's game. Stay away. Next, Martin. Nova Nordisk. This is what I told you guys last fall, that everyone said these things would go to the sky, and you know, I looked like I was bearish, and everyone's like, oh, they're going to keep going higher, and every single one of them is now down at least 25%, with Novo now down 66%. Not yet. Too many broken suckers who bought up. It's going to take time to build a base, at least a half a year. You got time to buy this thing. Let it go lower. Next. Morningstar's NOV view looked more bearish than bullish, with a price target of only $17. Are they always bearish? I don't care about secondary work. I do my own work, and this is a cyclical play that you have to have experience going through cycles. This thing, when it turns, is going to be 4x, 5x bags, and now is the period over the next few years where that's going to happen in our view, regardless of what Morningstar says looking in the rearview mirror. I was thinking recently, man, this is from Gareth Hancock. I was thinking recently, man, the only Tom Hayes pick that hasn't performed this year is VF Corp. What do you think? I loaded up last night just before earnings, and I'm now roaring at my screen. Well, Gareth, welcome back to Earth, homeboy. You just got smoked, but hopefully you had some dry powder to buy in the 11s and take your basis down, because this thing is going to be many, many bags over the next 5 years, and probably a lot sooner, actually. What do you think about UNH? No. Anytime there's a DOJ investigation, there is how a DOJ investigation goes is not our bad. We thought you were guilty. You're actually not. Here's a clean bill of health. They just basically, it drags on for 2 years. Management takes their eye off the ball. If you have to play healthcare, I'd buy like Humana or something like that. I wouldn't even mess with the lower quality Centene. I know it looks attractive, but they got all that Medicaid exposure. It's just, I'd go with something a little higher end. John Barry, do you think Whirlpool is now a buy? This is a housing play, so I don't need another housing play. We've got enough between Generac, Stanley Black & Decker, and QXO. It's a housing and rates play. And so is Cooper Standard a rates play. So I mean, their revenues just show zero sign of recovering. So I mean, no, I don't really. I think you're right, but there's no factual basis. I think you're totally right. Like looking at it as a trader, I agree with you. Looking at it fundamentally, I have no interest to commit any capital. Dan Lease, UNH, no. DOJ, happy to be wrong on that one. Steve, that's a new client. Next. Greg, inquiry. Greg Altamari, CNC, no. I would go higher end to Humana. Edgard, Abreu, Novo, no, just covered. Art M. Love the podcast. Continued optimism when everyone else is panicking. Not sure if this has already been covered. Thoughts on UPS? Continue to have my eye on it. I think you're going to be right on UPS. But it's probably time to buy UPS. Let me just take a look. So we got 19 billion of debt. The only issue is the balance sheet's a little bit leveraged, but other than that, I don't think you're going to get hurt buying it here. I think you buy if you really want to be in it. I think there are higher and better uses of capital, and I think it's going to take longer to build a base than you think. But I'd buy like half the position here, and if it goes down to 70, finish up your position, and then you know in 3 or 5 years you probably have a double and a half. But I could definitely see it starting to turn here. Let me just see what earnings estimates are for this one. By the way, you get a nice dividend while you wait, which will probably be cut, but for now it's nice. Let's see. Yeah, a lot of pessimism in the stock. I kind of like it. I know we've looked at it a million times and I kept saying lower, but now it's getting to the point where it's, you know, it's not going to. All right, Stephen Frampton. cut guidance and the dividend. Yeah, Stephen, and by the way, thanks, Stephen. He does all the incredible video work on our social platforms. I think you're right, Stephen, but I think it's got to go lower. And we have to see some signs of the turnaround before we guess that the turnaround's coming. But I think generally you are correct. I just think there are higher and better uses at the moment. Robert Smith, considering buying Dow, cutting the dividend. Yeah, if I like Albemarle for materials exposure. We keep looking at this one every week. I don't know what turned me off about it. Let me just see. Yeah, it's still negative free cash flow. Let's look for some signs of turnaround before we get involved. But yeah, it's probably getting close. Jack Lacomer, 20-year-old listening from Dublin, Ireland. Love listening to the podcast every week, gaining loads of valuable insights and your opinions, not advice. With recession risk in the U.S. appearing to diminish and some economic indicators improving, why does broad market consensus remain so bearish on the U.S. dollar? Is it solely to do with slowing growth from a U.S. perspective or consensus way too bearish? I think we are going to get a counter trend bounce because if you recall last year, I was bearish on the dollar when everyone was bullish. Now everyone's starting to become bearish. So we probably do get a large counter trend bounce, but the trend is down. We are going to have to inflate away this debt and grow above trend. And Trump wants a weaker dollar, and he'll say he wants a stronger dollar, but it's going to help our earnings. It's going to help our exports. It's going to make us more competitive, and it's what we need in the short term. If we have a high dollar, we're going to have problems with the amount of debt that we owe. So expect a counter trend bounce followed by a continued downtrend. DK Investments, thoughts on Teleflex, TFX. This one must be getting promoted on social because I'm getting a lot of questions on TFX. Yeah, this is a broken Momo stock. What do these guys do? Healthcare equipment and supplies. Free cash flow. Balance sheet's a little bit levered. Yeah. Huh. I mean, this is interesting on many metrics, except it's just so broken. I just I think it's going to take a little time. I'd love to see it like spike up to 150 and then kind of stabilize here for a while. From an entry standpoint, because this thing was this was a 12, 13, 14 bagger. And when they break, they take an awful long time to build a base, usually years. And I don't know if this has been building a base long enough. Just from an entry standpoint, from a fundamental standpoint, I kind of agree with you, but I just don't know the business well enough. I'd rather, personally be in what I know, which is Baxter. But I can't find anything dramatically wrong with it other than the fact is I don't have confidence that the bottom's in. Dylan, Cleary, X-ray. Here's another broken stock. Yeah, it seems like the revenues have just been flat to declining forever. Low return on capital. I mean, they're free cash flow positive, but you just have to you got to get comfortable around what's the turnaround story to reaccelerate growth. Otherwise, why would a floor come back in? Or was it just, basically what it was? It had a run, it had a special product, and now, is this another one of these invisible teeth thing that have become commoditized? No. Dental equipment supported by cloud-enabled solutions, dental products, healthcare consumable products in urology and enterology, connected technology solutions, dental solutions, orthopedic. Yeah, this has not been a great business. The big one is Henry Schein, I think, HSIC. That one's held up a little bit better. I'd have to talk to my friend Blake, who's actually in the business and understand the products a little bit better. And you would have to listen to 8 or so conference calls and understand how are they going to turn around this decline of revenues, because it just feels like they don't have any moat at the moment. But if you can get comfortable in the turnaround plan, you might have something here. It's just a very low returning business, which I don't like. Its return is probably meaningfully lower than their cost of capital. And that is a bad formula. Balance sheet's okay. Yeah, just get comfortable in the turnaround story and the product moat if there is one. And I think you probably have a decent enough margin of safety with this one. Let me just take a look at it. $4 billion. I mean, if these estimates are correct, it's amazing what's happening to the healthcare industry. I mean, this is one of those instances. I kind of like this one. I think it needs a lot more work, but I kind of like it, Dylan. Lee Foster. What do you think about Western Union? We've done that a million times. Not for me. Zach F. DCTH. Thank you for all you do. We're hoping to be clients someday. You will be. Hang in there. I had a lot of people that made enough money from the podcast to become a client when they didn't have it. It's amazing because okay, DCTH. This hasn't been around long enough for me to be interested, but I'll just take a quick look. Still negative free cash flow. No, not for me. This is a promote. Matt Gentile. Hey, Matt. Thursday is my favorite day of the week for over 3 years now. Thanks to Hedge Fund Tips. Love seeing the family's hard work and success. Pictures with merch soon to come. Love it. Love it. By the way, if you don't have your Hedge Fund Tips with Tom Hayes hat, mug, golf shirt, etc., you can get it at hedgefundtips.com. Click here, and then we're going to send in a picture. We're going to put you on the website right here under number one hedge fund podcast with all the others. What do you think of Centene? Yeah, I just don't like, this is like the worst of the worst. It's all dependent on Medicaid stuff. I just think this thing's broken. I think this was an Obamacare stock, and when that was gutted and now you got cuts to Medicaid, I just think a lot of these are going to be, I mean, look at all of them. It was all Medicaid. I mean, these guys wrote the Affordable Care Act for Obama, and they made fortunes. And now that game is over. They're cutting. So I just think that you got to understand granularly the impact. I would be like higher quality Humana. Cigna hasn't come down enough yet. But yeah, I'm watching all of them. Centene is not one I want to play with. This is a falling knife, in my opinion. Jason, thanks for all you do. What do you think of ADT? This thing is a chronic value trap. Always continues to fail. Too much competition. Always cheap. Always will be. Trading vehicle. Marco Staltari, ILMN. Yeah, this is China. I kind of bagged in it. He dumped out of it. I'm not ready to go into that yet. Alex Coe. Love your show every week. I stay up late to watch it every Thursday in the UK. What do you think about Pfizer? I think you're not going to get hurt at this level, but you're not going to make a lot of money anytime soon. Higher and better uses, but it's probably okay. Not return to a ZERP environment. What do you make of their opinion? Yeah, it doesn't have to go to ZERP for biotech to take off. It's already starting to happen. That's a nonsense article from Oppenheimer. GMed, I think we did last week, Max. Yeah, 7 days ago. All right, with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.